So welcome everybody to today's webinar, which is part of the Young Scholar webinar series on climate change, macroeconomics and finance, organized by the E-Access Forum. Today, Anna Maria Tenekedjieva will present her paper, The Limits of Insurance Demand and the Growing Protection Gap. Anna Maria is a senior economist at the Federal Reserve Board of Governors. She specializes in the flow of funds section. She holds a PhD in finance and has research interests in financial intermediation, climate change, insurance, and political economy. Anna Maria has been involved in research examining the impact of corporate money in politics on labor. Her work and expertise revolve around the intersection of finance and various socio-economic factors. Anna Maria is also one of the winners of the 2023 E-Access Forum Research Prize. Very happy to have you, Anna Maria. We're excited to hear from you about this very interesting paper. Thank you.
Thank you so much, Diego. I'm very excited to be here. This is joint work with Pari Sastry, Ishita Sen, and Tess Charlemagne. And I think that maybe Pari and Ishita may be in and out, so we may be able to even see them. But the usual disclaimer applies. The views expressed today will not represent the views of the Federal Reserve System. So without further ado, let me tell you about the limits of insurance demand and the growing protection gap. So over the last few decades, climate losses in the United States have been on an upward trend, and homeowner insurance premiums have started to rapidly rise as well. This has led to a very lively public discussion, particularly among policymakers, that these dramatically rising premiums are making insurance unaffordable for the average US household. And of course, we would like to join the very literature in economics about what determines willingness to pay for insurance by focusing on homeowner insurance in particularly. And we would like to think about what are the factors determining demand, implying for the future of the homeowner insurance market as climate losses continue to climb. Now, from theoretical point of view, there's two general schools of thought. We have the standard models of insurance going as back as Arrow 63 and Molson 68, where they would say that in the current situation, rising premiums don't actually pose any challenges for the markets, because as risks rise, households' willingness to pay for insurance will also rise because these households are risk averse. But a lot of these models, either implicitly or explicitly, are assuming that households have frictionless access to credit markets and that households can always use debt to finance insurance premiums by borrowing against future wealth. So these models make a very stark prediction, basically, that at actually fair prices, households will choose to be fully insured. And so, even though risk rises and premiums rise in accordance, there will be no change in how large the market is, and households will remain fully insured. Now, let's compare that to this alternative, more modern class of models that incorporate financial constraints, such as Rampini and Vishnawathan and Erickson Sidner. Basically, they're arguing that because households cannot frictionlessly increase debt to finance insurance payments, they can't access debt. And when these financial constraints start to bind, households' willingness to pay for insurance may actually decline as risks go up, because rising premiums tied to rising risk will actually exacerbate financial constraints. And so in this class of models, households may actually remain underinsured, even when insurance prices are actuarially fair. And an implication of these financial constraint models is that rising premiums that exacerbate financial constraints can in fact lead to shrinking in the market. And so there are these two broad classes of models making two distinct predictions with different implications for households' willingness to pay, for households' demand elasticities. And despite the fact that there is this rich tradition of theory, we haven't had much empirical evidence about these two classes in theories in the context of homeowner insurance. And the primary reason for this has been not really lack of interest, given how active the public discussion has been. It's mostly been lack of data. Until recently, it's been very hard to get good granular level information on homeowner insurance premiums and coverage, especially for the United States. And so there's been a lot of public speculation about homeowner insurance markets, especially in the last 5 years when premiums basically were moving at twice the inflation increases. So yeah, we would like to address the details of the demand side of insurance in this paper today. So we will bring in this very novel nationwide micro data set. This is a new data set which comes from ICE Magdash, the mortgage servicer data provider. And it has very detailed individual household level information, both of course on mortgage, but also with the associated homeowner insurance contract. And the data spans 2013 to 2023 and has nationwide coverage for the United States. So this data has been only released in the last few months, and we're going to start with some descriptive facts about the market, but we're also going to try to take a very deep dive into understanding homeowner insurance willingness to pay for households, as well as the role the debt markets play in supporting insurance. And using this data, we find that the average US household is in fact underinsured, with only 70% of their home's replacement cost covered by their insurance contract. So what that means is if there is a total wipeout event that destroys the house, the insurance payment will only cover 70% of the cost to rebuild this home. This means that households are not fully insured. And we're also going to see that the underinsurance level is strongly correlated with measures of financial constraints. And we're going to try to understand deeply the role that these financial constraints are playing in explaining households' underinsurance. So from there on, the paper will have two parts. The first is going to be us introducing a theoretical framework, which is a simple model that nests the insight of both the standard models and the financially constrained benchmarks. And we're going to use it to derive predictions on how both insurance coverage as well as credit debt should evolve with premium changes. And we're going to identify some key parameters that affect market outcomes. Those are, most obviously first, how households adjust insurance coverage when insurance prices move. In other words, what is the elasticity demand of coverage with respect to insurance prices? But there's also going to be two additional parameters of interest. The first is going to be cross-price elasticity of debt with respect to insurance price. In other words, how does mortgage debt adjust as insurance premiums change? And we're also going to identify how insurance coverage changes with respect to shifts in interest rates. That's cross-price elasticity of coverage with respect to the cost of credit. So our model is going to show that there are these three key parameters. And in the next half of the paper, we would like to actually identify and estimate those parameters using the novel data. To do that, we need an instrument for insurance prices in order to estimate demand elasticity and address some of these classic simultaneity bias problems. So to do that, we'll use a novel instrument based on exploiting regulatory frictions. In other words, for some insurers, it is hard to adjust premiums when risks shift. And we'll go into detail in a few minutes when we discuss the IV setup, but based on this, we will have these three broad sets of results. The first is going to be that even at actually fair prices, households are underinsured and have elastic demand for coverage. So again, this is not the classic, papers world of Arrow and Mawson. This is a different, world more closely aligned with, we're going to argue, financing friction. And indeed, we're going to identify this interesting heterogeneity of how households respond to insurance prices based on how easily they can access debt markets. In other words, how financially constrained households are. So we're going to find that financially unconstrained households respond to increase in insurance prices by increase in mortgage debt, but these households don't really adjust insurance coverage too much. So these unconstrained households are relatively inelastic in their demand for insurance because we argue they can adjust debt. And these debt adjustment can support their high levels of insurance coverage. So these guys are kind of acting like the standard insurance model agents. And we would like just, however, for the financially constrained households, these households are close to their binding debt limits. They can't adjust debt because lenders won't allow them to. And so what they do is they start to respond to rising insurance prices by dropping their coverage rates. And these households are truly the ones that are reducing coverage the most in response to changes in prices. And so whether debt adjusts or coverage adjusts when we have these increases in insurance premiums is going to depend on whether the household's financial constraints are binding or not, and the degree to which, of course, the household can access these debt markets. So to put our paper's findings in context, there is, we're basically broadly related to this growing literature on the interaction between homeowner insurance and real estate markets. And a lot of this is related to the recent availability of very new data. And people are studying a variety of issues here. By the way, there's, oh, sorry, I moved. Yes. Wow, I really moved them. Okay, so we are here. So this is just a subset of, the papers that's, are being presented right now, but, this is just a subset of the papers that exist. What we contribute to the conversation here is by truly focusing on the insurance demand. And in that sense, we're connecting much more to this sort of traditional insurance literature and thinking about the drivers of insurance demand. We briefly discussed the theory, of course. It goes back to, the mid-60s, which are the standard models. And of course, we already mentioned the financial constraints models from Pini and Vishnawatan and Erickson Sidner. But we're going to draw also heavily from work by such as Einap and Finkelstein on the econometrics of estimating demand elasticities. So there's also a variety of estimates in the literature on demand elasticities that come from other insurance markets, such as life, annuity, floods, and crop. But again, there has been limited, we haven't really have any estimates from the homeowner insurance markets. So our contribution is going to be threefold. First, we'll be the first to identify the own price demand elasticity for homeowner insurance. And we're going to be the first to identify these cross price elasticity between homeowner insurance and mortgage debt. So this is going to be an identification related contribution. The second is going to be that we're really going to hone on the role that financial constraints play when it comes to influencing households' demand for insurance and willingness to pay. And we're going to be the first to show that households are actually using mortgage debt to finance insurance coverage, which highlights just how interlinked insurance and mortgage markets have become. And I want to also emphasize that in terms of property insurance markets, the role that credit markets play in insurance willingness to pay, in households' willingness to pay for insurance, has only been shown to the best of our knowledge in the context of crop insurance. And these estimates are coming from Kenyan farmers, so a very different institutional setting. Now, what are the implications of our paper? Another way to think about our results is that financial constraints are reducing households' willingness to pay even below expected loss. And that's what it means for households to have elastic demand even at actually fair prices. But expected loss is the minimum that insurers can charge you for the product while remaining solvent. So basically, what this means is that we may see some destruction of the gains from trade that comes in insurance market, and we may see this having impact on the future of the market as well. So that's the first of basically two key takeaway. The second takeaway is that basically the market is going to start shrinking, both because financially constrained households are dropping insurance coverage when prices go up, but also because if current price increase trends continue, some of the currently unconstrained households will borrow until they become financially constrained as well. 70 to 31% of households will fit that criteria. And once they become financially constrained, they cannot borrow to fund increases in insurance premiums, so they'll start reducing coverage. And so putting everything together, what this means is that insurance markets may actually shrink in size even as climate risks go up. And this kind of raises the question of how useful financial markets will be exactly, in a future in which climate-related risks start going up. So basically, in terms of institutional details, in the United States, homeowner insurance is the first line of defense that households have to protect themselves against climate-related disasters. And mortgage lenders know that, and they require that homeowner insurance is maintained for the entire duration of the mortgage. As a result, we have limited evidence of underinsurance on the extensive margin. In other words, most US households have homeowner insurance contracts. That contract protects you from many climate-related disasters such as wildfires, hurricanes, tornadoes, etc. In fact, the only carved-out dangers are the federally provided flood and the state-provided earthquake. So in terms of the annual contract, there's two key features I would like to emphasize. The first is the coverage limit. So basically, this is the maximum payout a household is entitled to if there is a loss event and the entire house is destroyed. There's also premiums, which is what households are paying, in reality. This is usually done on a monthly basis, and of course, it's a function of many important factors, for example, risk, but also importantly, it is function of the coverage choice that households are making. Now, another key feature here is timing. So we're going to focus on the choices households make at origination of the mortgage, because this is the time when household is both choosing debt levels as well as insurance coverage. Now, when does household learn about insurance premiums? In the process of closing on a mortgage. Basically, it's this information seems to be acquired by the household after the household has decided on a house and put down a deposit. So in a way, they are pretty locked in a given house. But before the mortgage is fully closed, so households are still able to adjust loan amounts after learning about homeowner insurance premiums. And a final important detail is that oftentimes households need to put in escrow insurance payments for a full year worth of premiums at the point of loan origination, which means that the household is extra sensitive to any shifts in insurance prices at that particular point. So in terms of data, we bring in 6 different data sets together to create a nationwide state-of-the-art loan-level database spanning a decade, where we would like to eventually have characteristics of insurance and mortgages, as well as individual borrowers and individual property characteristics as well. So I won't go into too many details. I'll just emphasize the novel data set. It comes from ICE Magdash's insurance module, which basically tells you for the mortgages that Magdash provides information on what is the homeowner insurance contract in terms of coverage and premiums. And we also observe Equifax. So we also observe borrower characteristics through Equifax, from where we get the income of the borrower. And we tie that to core logic and RS means in order to get property level characteristics and estimates on local construction costs. So there's two key ratios here. One is coverage ratio. So when we talk about underinsurance, that's what we are thinking about. This is what is the coverage that households select relative to the cost it will take to fully rebuild the house if it is destroyed in a natural disaster. And this is called replacement or rebuilding cost. And there's also insurance price. This is the monthly premium, which is what households actually pay. And we divide that by the coverage level that households select, and we measure that in 100,000. So from the data, what do we learn about the coverage that the US households have? You can see from the histogram here that the majority of households have coverage ratio below 1. And in fact, the average US household as a result is underinsured with only 70% of rebuilding costs being covered. The people who have coverage ratio that will be, sufficient or beyond sufficient to rebuild their house are mostly on the right tail. Meanwhile, you can see that significant amount of people are severely underinsured with coverage ratio of less than 50%. Another important pattern emerges if we look at how coverage ratio varies across the United States. If you look at levels of underinsurance plotted on the map, you may notice that some of the most high-risk states in the country, such as the Gulf states, are also having some of the lowest level of insurance, which is contrary to the standard models that tells you as your risks go up, your demand for insurance will increase. What actually seems to relate with coverage ratio is the state level average income, which is, with cross-state correlation of 80%, while for climate risk, it's only minus 20%. So this relationship between coverage and income persists if we also look at the loan level. So here we are plotting a bin scatter of individual mortgages, where on the x-axis we plot income, and for each ventile we plot the share of households that are severely underinsured. And what you can see is that for the lowest income households, we see the highest level of severely underinsured people. So as income increases, so does the levels of insurance. So another important pattern emerges if we split the household based on what is their risk profile. You can see that among high-income households, those houses that are facing high climate risk tend to have more insurance relative to the low climate risk household. But in the low-income households, there's very little difference in the level of insurance. So the similar pattern will emerge if we also look not only in income, but other proxy of financial constraints, such as credit score. And this together tells us that when it comes to the unconstrained borrowers, the data aligns well with the standard theory in the sense that households are clearly valuing insurance. However, we see that lower income households in the most risky areas, contrary to the standard theory, are the ones that have the least amount of insurance. And we're going to argue that this is related exactly to financial constraints. So, the descriptive facts are clearly emphasizing the role of financial constraints, which leads us to introduce it in the center of a theoretical framework based, again, on the insights of both the standard model and the constraint models. And using this framework, we'll generate predictions on how households make decisions on insurance, as well as novel predictions on how credit demand changes with respect to insurance prices moving. So this will be fully described in our paper, but we're just introducing insurance decision in a standard dynamic consumption saving model with borrowing constraints. And what we find is that at actually fair prices, unconstrained households choose to be fully insured and will be fully inelastic in their demand for insurance. These households will finance any increase in premiums by borrowing in credit markets, and all of that is the world of Arul Molsen that we started with. However, if a household is constrained, these households will not be able to borrow, and as a result, they will choose coverage levels that will be below 100%, and these households will be actually elastic in their demand for insurance. This is more the world of Rampini Vishnawatha. Now, even if we move beyond the assumption of prices being actuarially fair, it still remains true that at and above actuarially fair prices, constrained households will choose less coverage and they'll be more elastic in their demand for insurance. In other words, when prices go up, coverage will be dropped, while the unconstrained household will maintain this high level of insurance coverage by borrowing more. So taken
just
together,
a clarifying question, Anna Maria. Can you explain in the model, what does it mean that the price is fair?
Basically, it means that premium equals expected losses. All right. So the model is emphasizing basically some important like some important key parameters that emerge from this model are these demand elasticities. So we'd like to estimate them in the data, but of course we are facing the usual empirical challenges. We have the classic simultaneity bias. We can't just regress coverage quantity or coverage on insurance prices. And in the case of debt, if we just regressed levels of debt on insurance prices, we're potentially inflating our estimate because borrowers with high climate risk may be facing high insurance premiums and may choose to remain. They may have higher demand for debt because, for example, they don't want to put too much equity in their home. So to move around these concerns, in a perfect world, we'll randomly assign different insurance prices to different households and examine how their decisions on insurance coverage and mortgage will shift as prices change. And to get close to this experiment, we will try to identify we basically need something that gives us variation in insurance prices that is exogenous to insurance demand and credit conditions. So to get that, we are going to rely on heterogeneous rate regulation across the various states. And here, basically, some states are high friction, where insurers are not really able to change their prices when there are shifts in risks or demand. And in the rest of the states, insurers are much more able to set the price that they choose. So what we're going to do is we're going to have two state least square estimates for low friction states. And we're going to use the price in high friction states as an instrument for the low friction state price as a first stage. And at the second stage, we want to know both how coverage and debt respond to these exogenous shifts, coming from high friction states shifts in prices. So under conditions we're going to discuss in a second, we can interpret this coefficient as the elasticity of demand for insurance coverage with respect to insurance price. And we can interpret this coefficient as the cross price elasticity of demand of mortgage debt with respect to insurance price. Again, this will be all at the loan level, and we're going to include zip cross ear fixed effects as well as controls for climate risk, replacement cost, households income, and credit score. So here we're making, of course, the classic relevance and exclusion restriction assumption. In terms of relevance, basically, we're claiming that prices in high friction states are reflecting prices in low friction states. Why is that? Well, insurers usually are operating across multiple states, and they're operating at persistent financial losses in these states in which it's hard to adjust prices. So what they do is they cross-subsidize the losses they incur in high-friction states by raising premiums in low-friction state prices, which is something, so basically this cross-subsidization pattern is something we discuss at full length in my paper with Ishita-sen and Simon O. So basically these spillovers, like to give you a sense of the gist of the paper, these spillovers are occurring because insurers are financially constrained, and when losses occur, they would like to change prices probably everywhere, but they can only do so in low friction states. And to show you that indeed these insurers are operating at persistent financial losses in high versus low friction states, here we plot profitability of insurers across the two state types. This is the annual combined ratio, which tells you for $1 that insurers collect in premiums, how much do they spend in terms of costs. So here you can see that in high friction states, insurers are basically not profitable, while in low friction states, profitability is much better. And what we also see is we have a strong first stage where prices in high friction states strongly relate to prices in low friction states. So the other identifying assumption, of course, is the exclusion restriction. In other words, the only way that high friction state insurance prices affect the demand for credit in insurance in low friction states is through their effect on low friction state insurance prices. In other words, high friction state prices are exogenous to demand for insurance and credit conditions in low friction state prices. Now, you can directly test exclusion restriction, of course, but we are going to show you evidence that shows that insurers in high friction states have difficulty setting prices to even reflect local actuarial risk. So it will be very strange if they're able to price in demand shocks coming from whole another state. So here we are showing the pass-through of climate risk into insurance prices. And you can see that in low friction states, there's significant pass-through, but all of the pass-through gets rolled back in high friction states. So we can treat the changes in insurance prices as exogenous to insurance demand and credit conditions in the low friction states that are out of the states for these guys. So what do we find? First, let's talk about what happens in high friction states where we just saw that prices are at or even slightly below actuarially fair. If you think about standard models, they tell you that at these fair prices, a household that is financially unconstrained will choose to have coverage ratio of 100% and will have coverage elasticity of 0. Instead, what we see is that coverage ratio is 68%, and which is significantly lower naturally, and coverage elasticity is much less than 0. It is minus 0.25. So what this tells us is that there are households whose willingness to pay for insurance is even below this minimum price of, insurers breaking even, which is again the minimum required for insurance solvency, implying that the model, implying that if insurance prices keep growing, the market will continue to shrink. So some of you may be wondering, well, what is actually fair? Maybe this is indeed about how generous the contract is. Let's contrast our finding with what we see in low friction states. If this was truly about the generosity of the contract, where the contract is much less generous, we would see that in low friction states, coverage ratio and elasticity are both much below what we see in high friction states. In contrast, we actually see that coverage elasticities and coverage levels are very similar for high and low friction states. And we're going to argue instead that what is happening is, what is driving this underinsurance in this market has to do with financial constraints. So we would like to know how coverage and debt adjust when insurance prices move. And we want to know how those adjustments are made based on whether the household is financially constrained or not. So the first thing we're going to do is we're going to proxy for financial constraint by splitting the sample by its mean into high and low income borrowers. First, indeed, low income borrowers are much more likely to be financially constrained. We show that they're twice as likely to be at a binding level of debt to income ratio or loan to value ratio So again, this is a good proxy for financial constraint. Here we show the demand elasticities for the 2SLS procedure in low friction states. And in columns 1 and 2, we show the demand elasticity for insurance demand, and in columns 3 and 4 for demand for mortgage debt. And we're going to, of course, show them separately for low and high income borrowers in columns 1 versus 2 and 3 versus 4. So what do we see? Let's first look at demand for insurance coverage. Basically, the more elastic segment of the market is the low-income household, where demand elasticity is minus 0.2. High-income households tend to be less elastic in their demand for insurance. Now, when it comes to demand for mortgage debt, however, the more elastic segment is the high-income one, where the demand elasticity is 1. This is basically double what we see in the low-income household. So taken together, basically what this means is that the more unconstrained high-income households respond to insurance prices increasing by taking on more debt, but dropping relatively less of their insurance coverage. On the other hand, financially constrained households, which is our low-income segment, respond to insurance prices going up by doing less debt adjustment, and they're much more likely to drop their insurance coverage. How much more? For the constrained households, 2% increase in insurance price will lead to a $5,500 drop in insurance coverage. We also want to know how much of the increase in insurance prices for the more elastic in terms of debt high-income households is funded through mortgage adjustment. And what we see is that 35% of the nominal expected burden from increase in insurance premium is financed through mortgage debt. So here we split the households into high and low income ones, and we argued that any differences in elasticity is due to financial constraints. However, this split is also potentially splitting households based on other important characteristics, such as different climate beliefs, risk preferences, etc. So basically, what we need is a plausibly exogenous shock to financial constraints, which we want to combine with the same instrument for insurance prices. To get this exogenous shock to financial constraints, we're going to use the government-sponsored enterprise rule that requires households to protect lenders if they are too levered. So if the loan has loan-to-value ratio over 80%, the household needs to purchase private mortgage insurance, which is an insurance that protects the lender, but the household paid for it. And as a result, if you're above this cutoff, as a household, you have higher borrowing costs by 50 to 80 basis points. So you're facing higher interest rate. So what we think is going to happen is that if you're above the 80% cutoff, you're facing higher price of borrowing. And as a result, you'll be more elastic in your demand for insurance coverage. We're going to look at narrow bands around the 80% cutoff. And we're going to make the identifying assumption is that any other, like in this narrow band, any other factors that affect insurance demand will be similar. So in column 1, we look at loans whose loan-to-value ratio is within 10% of the cutoff, and in column 2, within 5. Let's look first at the first 2 rows. Again, even below the 80% cutoff, households are elastic in their demand for insurance, as judged by the second coefficient. But the more financially constrained households are 30 to 50% more elastic. Now, you can say, wait a minute, people above the 80% households may be very different than the ones right below it. They may be less financially sophisticated, which is why they've agreed to be above the LTV cutoff as well. And as a result, because they're more, unsophisticated, they don't understand how good the insurance product is. That's why they're dropping coverage. However, notice that financially constrained households are actually having positive demand elasticity, which means that more constrained borrowers want more coverage at zero price, which is not consistent with, this alternative explanation of financial sophistication. And using the same logic of, the difference in signs of the coefficients between constrained households and how they move when the price increase, this helps us out through other important alternative explanations based on climate beliefs, risk aversion, etc. So to conclude, let's discuss a little bit the broader implication of our finding. Our findings have implications both for the market and for the individual households. In terms for the market, we see that due to financial constraints, some households are having willingness to pay for insurance even below expected loss, which again is what is required for insurance solvency, which says that as prices keep going up, more and more people will be dropping insurance coverage. And there's the direct effect, which comes from the households who are already constrained. And when prices go up, they're going to keep continually reducing their coverage in size. But there's also this secondary effect whereby some of the currently unconstrained households are becoming constrained as premiums rise because they're not able to borrow anymore. And a back of the envelope calculation suggests that if prices are growing at historical rates, using the LTV test elasticities, 70 to 31% of households will move from unconstrained to constrained and will start dropping coverage at rates similar with our constrained households. So again, both of these factors are leading to the market shrinking as risks increase. In terms of the households, we do show that underinsurance seems to be hitting households primarily through the fact that underinsurance wipes out their equity if natural disasters destroy the house. The lender seems to be relatively protected, and right now we're thinking exactly about how protected the lender is, but the first hit goes to the household equity. Moreover, we do show causally that underinsurance is causing mortgage delinquency, which is something we see especially strongly in the most financially vulnerable households, speaking about distributional effects of the effect of climate risks increasing. And as a truly final thought, we just want to point out that we're starting to see these dynamics play out in aggregate trends in high-risk states such as Florida, where between 2018 and 23, prices increased by 25%. What we also saw is that in this period, coverage ratio dropped by 4 percentage points, and households became more indebted, with their loan-to-value ratio increasing by 4 percentage points as well. Thank you so much for your attention, and I'm looking forward to your questions and discussion.
Really fascinating. Thanks so much, Anna Maria. We have now time for some questions. So I see that there are already some questions in the Q&A. If more people have questions, you can either raise your hand and speak up or also post your question in the Q&A. Why don't I start with a question? It's maybe a bit more big picture, and then we can go more into the details. But one thing that I was wondering is the following, because I totally see this mechanism that like underinsurance may be driven by the fact that basically there are these financial constraints, and as prices go up, fewer people can afford insurance. But another problem I thought that we have currently in US insurance markets is the problem of missing markets, that in many high-risk regions, insurers are either unwilling or unable to provide adequate insurance. So even people who are unconstrained financially may not get the insurance that they need. So I was just wondering whether you had any thoughts on that, or how this may relate to some of your findings.
Right. So this is definitely something we thought about, in terms of, what happens when insurers exit. The reason we kind of focus this more on the demand side is that at least for now, as a stopgap measure, we have seen the residual markets, the publicly provided options of states increase to, fill in the gap. So places where insurers exited started seeing more of this state option increase inside. Of course, it's not clear if over time this will remain true, but for now, in the short term, we think that it is mostly the financial constraint that is leading households to remain underinsured in the presence of this government option.
I see. Very interesting.
Thanks, Diego.
Stephen, would you like to speak up or should I read your question? So maybe I just read the question. It's in the Q&A by Stephen Cachetti. Said, this is extremely interesting. I was unclear what the data show us about changes in insurance coverage over time. Have things changed over the decade for which you have data? So I guess at the end you showed a bit of the trends for like 2 years, but maybe you could add some more detail on that.
Right. So basically, over time, we have seen relatively small so we looked in aggregate shifts over time, and it seems like there have been relatively little drop in overall insurance. Again, we think that this will change, which is this entire idea of, willingness to pay below expected losses. We're just starting post-COVID to see some of these big increases go up, and we think that over time it will become much more visible. And I think that if we only look at aggregate trends, exactly because we are aggregating financially constrained and unconstrained households, it kind of hides some of the story that, I think that at some point we plotted it among the financially constrained. I think that coverage levels have dropped.
Okay, there it's even more visible. Then there is another question by Agnieszka Kadili. She is asking about the role of information asymmetries. So whether it could also be that information asymmetries may have changed over time, and whether that could also explain part of the phenomena as we see, like in terms of underinsurance.
So yes, potentially we were worried that some of the financial constraints, what we attribute to financial constraint can be due to exactly like informational differences, right? Like especially when we split low and high income households, these are very different. Right. That's why we introduced the loan to value, test. And again, I want to point out two things. First, even in the low high income households, if a household is, say the high income households are so sophisticated that they believe that they want to be insured because they understand climate, it's unclear why they would borrow more mortgage, right? Like that kind of exposes them over time through their equity to these losses, which is kind of what ticks us that maybe this is not the primary driver here. And moreover, in the loan to value ratio test, it is important again to note that those that are first around the cutoff, people with 79% LTV versus 81% LTV likely have very similar, beliefs about and information about climate as well. But we also see that being financially constrained in itself tells you that you would have chosen more insurance had the price been zero. It is just that when insurance price moves, you have less ability to wiggle, if you will.
Got it. Okay. There is another question by Matteo Ficara, and he is asking whether you could provide some more details about the institutional or political reasons behind states who have like high friction in insurance markets. And it also relates a bit to a question that I had, which is maybe a bit related to your exclusion restrictions. So to what extent are these high friction states correlated with the extent of climate risks in these states? That would be interesting.
So in our paper, that was kind of like one of the, like, as you can imagine, as a condition to publishing it, we had to think very carefully exactly about those issues. So it seems like if anything predicts friction, it seems to be slightly climate losses, right? So places like California, of course, have higher losses. But again, this tells you, okay, this doesn't tell you anything about, all we need is that prices move at random in high friction states. It's not political. We've looked into that. At some point, insurers manage to get to negotiate with, with a state to get, to move up. And there's a lot of variation in terms of when you get your approval. So the timing is exogenous, and that's what we're using. And we want to know, once prices in high friction states move, when you have these spillovers into low friction states, how do households in low friction states respond in terms of insurance coverage? So that is the mental exercise here.
That makes sense, yeah. Can I just push a little bit more on the
Of course,
exclusion
yeah.
restriction? Sorry, I
Push
don't want to be
away.
the identification police here, but so just wondering because yeah, so I get that. So the timing seems to be plausibly exogenous, but then that like these effects of these high friction prices only work through affecting prices in other states. That's not completely obvious to me because you could also think, say, maybe or okay, because you're saying the timing is exogenous. My worry was that maybe there is like some climate risk that sort of pushes the regulator to overcoming this friction, but these climate risks may also affect other states through other channels such as trade, for instance. So I guess that was the concern I had in
I
mind.
mean, we thought a lot about it. We discussed it at really long length in the paper, like exactly like what else can be like learned. So first, there's very limited learning across states, is what we showed in our other paper, right? Like we have a whole appendix on that. But you know, in a way, it's going to be very weird. So what we need is the demand for insurance in low friction states is not affected by prices. And it's going to be very strange if you're sitting in Virginia, which is low friction state, see the prices increase in high friction states and say, I'm going to drop coverage, like, so it goes the opposite way, in a way, like to this learning story and a lot of those concerns. And same for the debt level, right? Like, it's, if you're a lender, like, why would you, why would your take home messages, I want to lend more and be more exposed to these potential faster processes now?
No, that makes sense now. No, I think it's a very persuasive setting. We still have some more time for questions, so I just wanted to ask the attendees whether there is any other points you would like to discuss. Please raise your hands if you have any other comments. I do have one other question in the meantime that's related to the measurement or the proxy of financial constraints, because I mean
Right.
income and also credit score, which I guess very highly correlates with income, is but one proxy. Maybe a bit one that is a bit more common, especially in macro, is liquid assets or cash in hand, right? Thinking of wealthy hand to mouth, right? That like some of these households, they may look as they are unconstrained because they have high income, they have a big house, but still they're very much constrained. So there's sort of these wealthy hand to mouth that have like very high debt and sort of almost behave like they were living paycheck to paycheck. So I was wondering whether you had any thoughts on that.
Right. So, first, our results are, I think that in the paper, it's in the current draft, like, results are robust to splitting into high, low FICO scores, credit scores. Exactly because we were worried. I think that actually we were not sure if people will buy the credit score story. That's why we actually introduced the income as a variable. We brought in a whole new data set to address this. So I'm gonna push back against the idea that one is more intuitive than the other. I think that different people, hear different things. So that's why we did both. But also, again, like, I want to point out that we do this LTV test that tries
Yes.
to narrow exactly that this is financial constraints, right? That's, and that's what's driving the difference in elasticities. And it's very stark, like 30 to 50% more elastic, if you're, facing higher costs of borrowing. We thought that that's very interesting. And again, the direction of the coefficients is what tells us that this is about insurance and not about selection on the each side of the LTV cutoff.
Super interesting. Maybe one last point because we still have a couple of minutes before we wrap up. Sorry, I don't want to pester you with questions, but it's just so interesting. So one thing I was wondering whether you could look a bit into the heterogeneity. I think because maybe you could look at
The
the. I mean,
heterogeneity of what? I'm sorry.
you're estimating sort of an average treatment effect, right? So I
All
was
right.
wondering whether you could look at heterogeneous effects either say in different regions or I don't know whether you have this information you could look like urban, rural or things like that. I think that could be
Oh,
fascinating.
yes. So I think that we try to do a little bit of that. Point taken that we could have done a little bit more. I think that it was fascinating that like, there was this almost, so some of the highest levels of insurance that we see are in the, Atlantic Northeast, like places like Vermont, where you don't necessarily think like big losses. And the higher the losses, the higher the insurance prices probably, and the lower the underinsurance, which tells us that financing constraints are kind of like the primary driver, because it is exactly like the standard model tells you, if you're less wealthy and face higher risk, you will demand more insurance because you can't consumption smooth. If you're a rich person, according to this model, you will self-insure a little. And it's exactly the opposite we see. So we can do more in terms of trying to isolate, some of these trends, but I agree with you. It's absolutely fascinating. It's kind of like contrary to what you learn in Econ 101 about insurance.
Very interesting. Great. So in case there are no other questions, let me take this opportunity to thank you all for joining, and most importantly, thank Anna Maria for a very, very interesting presentation. I certainly learned a lot. And then I also have an announcement to make about the next webinar, which will take place on June 2nd. This will be another Young Scholars webinar with Lucas Rachel from UCL, who will present the paper Emissions Adjusted Total Factor Productivity. And another announcement regarding the E-Access Forum Research Prize. The theme has been announced and the call for papers is now posted on the E-Access Forum website. And that's a great opportunity for young scholars who are working on climate policies and financial markets. So please have a look at that and consider applying. Thank you all.
Thank you from me as well. It was a pleasure.
Thanks, great to have you.